making an investment, what you're really doing is you're looking for profit, whether that's income or growth in the value of the investment. However, all investments come with risk. That's the amount of risk you're willing to take in order to get the profit that you want. In thinking about how to manage your investment risk, you have to be clear about what you want, what risks you're prepared to take to get the gains that you're after. So ask yourself, is the investment suitable for your goals? Get hold of the information and look at it, and stay informed once you're invested. It's worth noting that many providers of investment products are regulated or checked in some way, but many aren't. And it's important that investors need to play their part by doing their due diligence. So there are many types of investment risk that you might be taking. First of all, we'll start with product risks. So for instance, liquidity risk, which basically means there'll be no one around to buy your product when you need to sell it, so you can't get your cash back when you need it most. Credit risk, for instance, is when an organisation can't pay you back the money when it's due. Currency risk, which is a particular issue for New Zealand, where the value of your investment may be affected by changes in the exchange rate. And lastly, market risk, where the speed and extent of price movements may cause you to suffer loss. Another type of investment risk that people talk about would be portfolio risks. So for example, diversification or concentration risk. Put simply, this is the risk of having all your eggs in one basket. So for example, you've invested some of your money into a property in Auckland and the rest of your money into property stocks. There are a number of other types of investment risks you should watch out for in making investments, and I'll call these scams and frauds. A good example would be cold calling. It's almost never a good idea to respond to someone you don't know who calls you up with an investment idea. In all investment scams, a clear feature is the promise of big profits with little risk. Be very wary of that. I'd also advise you, don't give money to someone you can't check out and someone that you don't know. And be cautious even if you have heard that others have made money. Really, if it's too good to be true, it almost certainly is. And any offer of great returns with little risk, you have to be careful. If it really was that easy, we'd all be doing it. So there's a few other tips that you can consider when you're thinking about making investment decisions. So first of all, really get to know yourself as an investor first. Really ask yourself the questions about what it is that you want and what risk you're prepared to take. Sit down and spend the time. Secondly, disclosure information. It's there to help mitigate product risk, so read it. And lastly, think about getting advice from a professional financial advisor. They can help you understand risk and where to find the best information and the best fit for you. So you can find a list of authorised financial advisors on the FMA website, and you can also find some guides for questions to ask. So if you need some more information on any of these topics, please feel free to look at the following website.